Pratik Agrawal joins us now. Let's take a conversation forward and let's understand from him where he feels that markets, in a sense, are headed. I'm just going to mark first the Bank Nifty once again because that, in a sense, is showing a lot of price action and a lot of action in terms of a comeback. Pratik, I'm just coming right back to you. Let me just mark the Bank Nifty once again for the benefit of our viewers because that is really gaining some traction. So between today and between yesterday and today, the Bank Nifty has added about 1300 points, about 1400 points, and specifically that is good news. That is something which I think we must remember and we must really rejoice in terms of market action right now. Pratik Gupta, Managing Director with Kotak Institutional Equities, is ready. Pratik, good morning. Thank you for joining us.
Hi, good morning.
We were looking at data in terms of how markets are now reacting to each time there is a concern on the medical front. And even though the world is worried about the Omicron virus, looks like markets have understood how to deal with it. Because S&P is almost at a record high. Indian markets have recouped whatever they've lost in the last couple of days. Do you think now on the medical front, irrespective of what is coming out, markets are immune to it?
Nikunj, hi, good morning. Yes, I think the virus risk is still not over clearly. This Omicron virus, as reports are suggesting, can be far more contagious, but hopefully a lot less lethal. But I think from a market perspective, from an economic standpoint, as you rightly put it, the main worry is the fear of lockdowns and all kinds of restrictions on travel and so on. I think economies around the world have sort of figured out that the way around it is not to just lock down the economies, but instead, you mask up, you vaccinate, you take all kinds of precautions while traveling, RT-PCR tests and so on. And the kind of lockdowns we saw last year, or frankly, even early part of this year, especially in a country like India, where we've actually had a very good success in terms of vaccinations of the adult population. And hopefully we'll have a booster policy soon as well. I think we are well positioned, but nonetheless, the risks are out there. There is obviously some worry about the COVID impacted sectors like travel and hotels, restaurants, movie theaters, and so on. So those sectors are still a bit risky right now because people are still worried about getting together in crowded places or so on. But in general, from a market perspective, that's not as much of a risk. You're right.
Pratik, the outlook for economy is not looking bad. It's not dim. It's quite optimistic. Capex has started. Industrial recovery is evident. We are now debating what would be the earnings growth. We are not debating whether there will be growth or not. It is about whether it's 10%, 12% or 15%. That is the underlying thought in the debate. If the outlook is constructive, if the economy is looking to, if the economy is going to be better than FY 21 and 22 for FY 23, why are banks underperforming?
So on banks, actually, there are a couple of reasons. One is more of a macro reason, which is that of foreign selling, or rather more of a technical reason of foreign selling, and banks are heavily owned by the foreigners in most global emerging market portfolios. Just to give you some numbers, in October, we saw almost 40,000 crores of foreign selling. In November, and in December, first 7 days, I think we've already seen about 14,000 crores worth of foreign selling. And banks are typically, the largest part of the index. So there's a lot of selling which comes in over there in particular. So that's been one reason where foreigners were overweight on banks. The other was obviously the worry about the asset quality earlier on, and also prospects for loan growth were not looking very strong. And thirdly, you still have prospects or worries about some segments within the bank, such as the unsecured loans, the SMEs, the microfinance segment. These segments still haven't fully recovered. And last but not the least was the growing worry about the impact of fintechs on some of the banks. Our view is actually slightly different. We think, if you have a 12 to 18 month investment time horizon, the bank space is actually quite a good space to be in. As you rightly said, we think the economy is poised for a pretty sharp upturn over the next 2-3 years. All the building blocks are in place, both from a macro perspective as well as from a corporate India perspective. We could be embarking on the next round of capex cycle in the next couple of quarters. So the banks are one of the best ways to play that. The loan books have been cleaned up. The corporate NPN cycle has come down. And typically in a rising interest rate environment, you tend to see, spreads and margins actually expand a little bit. So the banks are actually quite well positioned. And as far as the fintech threat is concerned, that we think is somewhat overblown. Most of these fintechs are typically attacking the fee pools and not the lending space. The lending space is far more difficult, and that accounts for the bulk of the revenue for the banks. So, and also I would say that some of the private banks, which are really our top picks, they're not sort of sitting back and watching the fintechs come in and eat their lunch. Unlike, I think, what's happened in, let's say, China, where most of the banks are state-owned, or even in the US, where the traditional banks, they were sort of slow to react and adapt to the digital shift which was underway. Over here in India, most of our private sector banks in particular have been quite quick in terms of ramping up their digital capabilities and their digital offerings. And I think in the next 1 or 2 years, they'll come out quite strongly. So banks is one area where we are quite bullish on. We think valuations are reasonable. This is one sector which has underperformed, where valuations are still somewhat reasonable compared to a lot of the other sectors which are out there. So we're actually quite bullish on banks from a 1 year plus perspective.
Good morning, Pratik. So you're clearly very bullish on banks, and you've also made it clear you prefer the private sector lenders. But just to play on that capex theme, because this time round, what you're seeing after 10 years is a revival in the capex cycle, right? So besides banks, how would you play that?
So you're spot on. We're quite bullish on the capex cycle as well, and there are different ways to play it. One is obviously the banks. Their loan books should go up, credit growth should start picking up, and anyway, the credit costs are coming down. So apart from banks, we like the capex plays. You have the large, the capital equipment providers where order books are actually looking good. The worst of the raw material pressure, which we saw back in the September quarter, that also is behind us. But I think strategically, we haven't seen a proper capex cycle, a private capex cycle for the last 10 years or so. And we think, as the capex cycle comes in, not only will you see earnings upgrades coming through, but the stocks potentially can get re-rated even from where they are right now. And we think the margin expansion is the area which could surprise on the upside. And frankly, it's typically all the infrastructure providers or the capital equipment companies, which I think will benefit. Like I said, a lot of these companies haven't really seen a strong order inflow environment for the last 10 odd years. And I think investors and analysts have pretty much forgotten what the high margin environment can look like. But you will see a combination of very strong earnings growth, very strong free cash flow, and high return ratios, and which is why I think the capital goods space is the next bet we would take, again, from a slightly longer term, 1 year plus perspective.
So you'll take a bet on capital goods, I can make that out, manufacturing activity. A lot is also being talked about, for example, textiles. Is this a time to maybe start adding those kind of stocks in your portfolio? Because the chatter also seems to be to go back to where you're going to see that momentum in capex coming.
Yeah, textiles, yes. Unfortunately, it's a bit of a smaller segment. So not for most institutional investors, we don't really, liquidity is a big issue. But in general, yes, the textile space is also recovering. There is a whole China plus strategy. A lot of these textile companies have improved the balance sheet, deleveraged quite a bit. So and the other thing historically in the textile segment, governance was a bit of a concern. I think in the last couple of years, a lot of these companies have cleaned up their act. But in general, yes, I would agree on the textile space also.
The other sector, and I'm also asking this, of course, on the day of the credit policy day, is it's rate sensitive real estate. Look at the comeback of the real estate sector, the construction boom. Not just in the metro cities where you're seeing the big developers come out with their projects, but even in rural India, the reports that are coming in of the construction activity, real estate is a multi-year boom. Is that something that has you enthused?
Yeah, absolutely. Actually, we've been quite bullish on the residential real estate sector in particular for a while. And we think it is a multi-year story. And the general pushback from some investors is, oh, these stocks have already rallied. But our response is there is still a lot more potential over here. The industry consolidation is still ongoing. In fact, it's probably picking up pace. Affordability has improved quite dramatically. Housing prices haven't really gone up haven't gone up sharply in the last 4 or 5 years in most metro cities. Interest rates are low, and frankly, we don't see interest rates rising too sharply in the next 1 year. So affordability is good. There is industry consolidation. A lot of the property companies have actually deleveraged. The balance sheet is much more solid. And I think in the next couple of years, a lot of these companies we could see a lot more project launches coming through. And what's not factored in is the potential for price increases, which could come through in the next year or 12 to 18 months, which could provide the other leg of earnings surprise. And in general, our preference is within the real estate space, like I said, firstly, residential. And within residential, we tend to prefer more of the Bangalore-based plays, but some of the Mumbai plays also look quite interesting to us.
Pratik, I'm curious to know what's going to be the fate of these new listed plays, the frothy IPO market, if you will, now with the anchor limits getting opened.
You raise a very good point. For all these new listings, there are actually 2 tests, not just the anchor limit, which is the 30-day sort of lockup expiry when the anchors can come out and sell. But there's also the 1-year lockup for the pre-IPO investors, and that's another sort of milestone you should watch. So, a year from whenever these stocks got listed. So that's really the test for what the true valuation is. And these stocks are, frankly, till then, they're not really publicly, the price has not really been fully discovered. A lot of the investors are locked in, they can't sell. So we should see the real price discovery happening then. But having said that, I think the good businesses, where the addressable market opportunity is big, where companies have successfully created a moat in their respective areas, where the gross margins, the unit economics are actually profitable, where these companies have shown the ability to scale up, and where they can withstand competitive intensity, as well as managements where they've proven their ability to execute, their ability to adapt, pivot to a new theme, etc. Those businesses, I think, will still attract a lot of interest. In fact, some of these anchor lockup expiries or the pre-IPO lockup expiries, they could actually result in better liquidity. One complaint from a lot of global investors is these are great businesses. We want to own them for the next 3 to 5 years, 10 years, etc. But these stocks just aren't liquid enough in the secondary market. So sometimes the lockup expiry actually tends to attract even more buyers when the lockups expire. So let's see. It's going to be interesting, but as always, that's more of a technical factor, but nonetheless an important technical factor to keep in mind.
It sure is, isn't it? So, Pratik, if I were to ask you, after the fall that we've had from the October highs, what is it that you're buying, selling, and holding, just tactically or sectorally? You've already talked about your preference towards private banks, real estate, as well as textile themes. What outside of this list?
I think just before that, just a couple of things to keep in mind that as far as the global investor sentiment towards India is concerned, I think we're still a bit cautious on that front. India still, unfortunately, stands out like a sore thumb in terms of its outperformance versus other emerging markets this year. India's up 23%, China's minus 6% this year. Keep in mind, the S&P itself is up 25% this year. So from that perspective, trying to get global investors interested in India at a time when the Nifty is trading at an FY23 valuation of about 21 times, 2 times above its standard deviation from a PE multiple perspective last 10 years or so, it is quite difficult. So which is why you're seeing a lot of foreign selling. So which is why in the short term, there is a risk that the market doesn't rally and the foreign selling kind of overwhelms and continues to be a drag on the local buying that we're seeing. The second thing which hasn't been talked about much in my view is also the risk of higher oil prices. We should just watch out for that. It's not because of the winter months or demand supply or OPEC. I think it's more of a geopolitical risk, which in my view is being sort of markets in India in particular, I think, are being quite complacent given the risk of, for example, the Russia-Ukraine border crisis. If that results in some kind of severe sanctions or some activity over there, then oil prices could shoot up quite sharply, and that obviously India being a very large oil importing country, that puts us at risk. But if you put that aside, and frankly, we can't really predict geopolitics, but as I was saying earlier on, we are quite bullish on the economic cycle. We think the RBI is going to be supportive. Rate increases will be somewhat modest. The earnings increases, earnings growth is looking very strong. This year, we expect the Nifty earnings growth to be about 34% in FY22, 15% in FY23 with upside risk. So therefore, we'd like to play the cyclicals. Financials is one. I would say within financials also the housing finance companies, which are looking quite attractive. Another way to play the real estate sector, the industrials, the cement companies, real estate, and also the commercial vehicle segment, where I think some of these stocks have already corrected quite a bit in the last few months. And we are beginning to see signs of the freight rates, the freight income of the fleet operators going up, fleet utilization capacity going up. The age of the fleet is quite old now, so therefore we could see a pickup in new truck ordering activity. So generally, the cyclical sectors is what we would be looking to buy, over the next few months.
Everybody is now suddenly bullish on industrials and cyclicals, whether it is brokerages or fund managers. Isn't that cyclical trade getting more like a crowded trade?
Not really, in the sense that, firstly, from our side at Kotak, we've been bullish on these sectors for the last few months. But I think also, if you look at the valuations, it is still the other sectors which I would say are slightly more expensive, whether it's, you look at, for example, Midcap IT or Midcap Chemicals or Midcap Consumer Durables. You look at the FMCG companies and the consumer discretionary companies, they still remain extremely expensive in our view, and we would be a bit cautious over there. So I think from an earnings growth perspective, from a potential for earnings surprises perspective, it is really the cyclicals where there is probably a far more upside. And most analysts are still sort of assuming FY23 will be, kind of barely back to normal kind of a year. But things could surprise on the upside, given the way the government capex is going in, both central government as well as state government, and perhaps PSU capex as well, and followed by private sector capex, which is sort of yet to pick up in a big way. But that I think we could see earnings surprise, especially on the margin front in late FY23, FY24. And that's where you could see, earnings surprises coming through and stock prices following that.
There is growth in IT, but are markets factoring in that growth of double-digit and double-digit margins? Is this near perfect golden scenario what IT companies currently experiencing? Is that in the price?
We think for the mid-cap ITs, it generally is. Some of these stocks are trading well above their large cap peers multiples. And in our view, these mid-cap IT companies have done extremely well. Obviously, they've seen a very sharp revenue growth and margin expansion. But also bear in mind that in terms of the ability to really capitalize on the ongoing multi-year IT services, strong demand environment, it is really the large caps who have the capability and the client relationships. And I think importantly, to manage the attrition, they have the training infrastructure to meet the client requirements. In the short term, the mid caps tend to do well, but if you take a slightly longer term scenario, it's really the large caps who have the capabilities to move up the value chain, who have the capabilities to provide AI, machine learning, obviously cloud migration, and so on. And the ability to withstand the margin pressure due to wage hikes is probably far better at the large caps. And also given as I said, the valuation differential is much better. So in favor of the large caps. So we prefer the large caps at this point in time. There are one or two mid caps we like, but generally our preference would be for the large cap IT companies.
Okay, you prefer large cap IT companies over to the mid-tier ones where we had seen phenomenal triple-digit type of returns this year. Pratik, before we let you go, you told us what you are buying. We've been asking all of our guests about what are they buying, selling, and holding. What's on your sell list?
So I think on the sell list, given the fact that we are likely to see higher interest rate environment next year, and so therefore stocks where valuations are getting a bit excessive without potential for dramatic earning surprises, those are the areas we would be careful of in overowned sectors. So mid-cap IT, mid-cap chemicals, mid-cap consumer durables. This is one area. I would say power utilities, which are kind of bond proxies, which don't tend to do very well in a rising interest rate environment. The consumer staples companies generally we think will underperform, even though in absolute terms they may sort of improve given the sort of improvement in the rural economy and the pre-election spending which comes in. But generally, and then I forgot the upstream oil companies. Those are the likes the Coal India type of companies. PSUs in general, we would be a little bit cautious over there.
Okay. So thanks a lot, Pratik, for always joining us here today on this live edition of